$100 trillion. That's how much debt governments across the world are in today. The US alone accounts for 37 trillion of it, and AI is what could cause it all to collapse. Let me break it down for you. We live in a world driven by debt, which governments of every country have pushed towards crisis level. And that system requires prices to keep rising because inflation makes old debt easier to repay. But AI is deflationary. It lowers costs, replaces jobs, and drives the marginal cost of production towards zero. An inflationary debt-based system facing deflationary technology. They're opposite forces. They can't coexist. And don't just take my word for it. Sam Altman says AI is deflationary. BlackRock, the biggest asset manager in the world, says the same. And we're already seeing it. Last month, US job growth was revised down by 900,000. Their jobless claims just hit a 4-year high. The jobs that are being created are all in healthcare, education, and government. The UK shows the same pattern. New jobs are concentrated in those same sectors, and reports show that new graduate jobs are being lost to AI, all whilst big tech companies lay off record numbers of staff because AI makes them more efficient. Despite all of this, those in power will still tell you an AI productivity boom is the answer.
With AI, we can go back to the paradigm when I was younger in the 90s. Alan Greenspan was able to run the economy very hot because it was the IT boom, and we had this very powerful non-inflationary growth. I think that it's highly likely we could have that now. That kind of growth would bring down the deficit very quickly.
That's US Treasury Secretary Scott Bessent, but he's missing some very important facts about the 90s technology boom that he loves to point to. During that time, the Fed kept rates lower for longer than needed, fueling credit creation that offset the naturally deflationary impact of technology. At the same time, China entered the picture. The US trade deficit with China exploded as cheap imports poured in, masking the inflation that low rates would have otherwise caused. On top of that, the US was running a budget surplus, and debt to GDP was around 60%. Without all of those conditions, the technology boom would have been purely deflationary. Fast forward to today, debt to GDP is 120%. They're running a massive deficit that only grows bigger, and policy is restricting cheap imports. The run it hot play of the 90s isn't a model to copy either. It inflated asset bubbles, caused the dot-com crash, and laid the groundwork for the global financial crisis. It's simple. A credit-based system that requires inflation to survive cannot be rescued by deflationary technology. It makes it worse. Governments will be forced to create inflation to offset its impact, and that means reaching for the only tool they've ever had: print money, devalue currencies, and make the debt worth less in real terms. Systems like this can only be pushed so far. They always end in collapse, and the only protection is scarce assets that can't be printed, like gold, and most importantly, Bitcoin. I make videos just like this to show people the reality of the system we live in and why Bitcoin is the solution. So if you want to learn more, hit the follow button.